Halo, kembali lagi bersama saya Maura di GRW. And today we are going to talk about the US stock market with Mr. Sebastian here. How are you today, Mr. Sebastian?
Great, thank you.
It's been around 2 weeks since the last time we talked about the US stock. And maybe we could look back and talk about what happened in the past 2 weeks around the US stock.
Not much. I think the market is up maybe 1%.
So the movement of
Not
the
much
market is
change.
it's not quite big, right?
Not very big change at the moment, yeah.
Okay, so the market is moving a little bit slowly.
A little, yes.
In the past 2 weeks.
Yeah.
Okay.
It's been quite a good year so far, but the last 1 month, couple of weeks, a bit slow, yeah.
Okay. Probably because we're nearing September as well.
Yes, the famous dangerous time. September, October is traditionally dangerous for stocks, yes.
Maybe that's also the reason why the market movement is a little bit slower. Maybe,
but we're not there yet. We've got a few days. So in the beginning, yeah, September is I think on average is the most negative month for stocks. And then October, I think, is the most volatile.
It was volatile. Okay.
Crashes in October in the past.
So we'll see what will happen this September and this October, still coming soon.
Yes.
Coming right up. Okay.
He continued.
To be continued, that is correct. Okay, so we're going to talk first about the macroeconomy and also the inflation. The US inflation last recorded at around 2.7% per July 2025, with core CPI up to 3.1%. Is this downward trend strong enough to ensure the Fed will start cutting the rates this year?
That's a good question. Yeah, the inflation is kind of stable at the moment. It's not high, it's not that low. It's been around this level for probably about a year. It's a little bit lower than it was at the beginning of the year.
But where was it?
This is in the US.
Where was it before?
I think beginning of the year was around 2.9, now it's around 2.7. So it's a little bit lower, but it's kind of flat. And it's not too high, not too low. But if we look at some of the other countries, like the UK, the inflation is already back up to 3.6%. So there are some signs that the inflation is getting a little bit higher again. So for rate cuts, yeah, I mean, many other countries already cut the rate.
Okay.
And the US has not cut the rate yet. There's a lot of changes going on at the Fed, people getting fired because they didn't cut the rate. So yeah, I'm guessing there will be rate cut.
Okay.
Maybe not that much.
Okay, but I think that it might be cut.
Yes, because the US is lagging behind. So many other countries, they already cut the rate.
Lagging behind?
I mean, because they didn't do anything.
Okay.
In UK, for example, they already cut the rate down 1%.
They already took action.
They already took action. The Fed did not take action. Donald Trump is very angry about that. So they're firing lots of people. So maybe they will take action. But yeah, maybe the possibility to cut the rates a lot is not so big. Yeah.
Okay. I see. So the difference might not be that much.
Yes, I think so.
Okay. So how significant is the role of inflation in shaping market expectation compared to, let's say, CPI?
Inflation is, well, if you compare it to interest rates, of course the interest rate is the main thing, because when you buy an investment, you're comparing what is the return, and you compare it with the benchmark interest rate. So everything that you invest in is kind of like an interest rate. So obviously that's important. And is the inflation important with interest rates? Yeah, there's of course a relationship, but you know, it's not necessarily exactly the same.
Okay.
But obviously, I think if there's higher inflation, it makes it a little bit more difficult to cut the interest rate. And in fact, if we look at the market interest rate, because the Fed, they make their own decision, but the market also has interest rate. So there are government bond yields, and the government bond yields are kind of flat to rising, I would say. If you look at interest rates outside of the Fed, then they are kind of flat to rising at the moment.
Okay.
Not just in the US, but in Europe. In the UK, in Europe, in Japan.
So it happens.
Government bond yields in the market
Uh-huh.
are going up, not down. And for the stock market, that is more important, I think, than the Fed.
So this happened in few countries then, not just.
Yeah, it's happening in Japan, it's happening in Europe, it's happening in the US also, especially for the longer. So, in the US, they have 30-year bond. UK, they have 30-year bond. In the UK, the 30-year bond yield is at 30-year high.
30-year high.
Yeah. So those long interest rates, because the Fed is at the short term,
Yes.
these bond market interest rates, which are much longer, they are rising, not going down. So that puts a little bit of pressure on stocks.
For the US stocks.
For every major market. Here in Indonesia, it's the opposite. The bond yield is going down at the moment, but the interest rate here is much higher.
Higher, yes. Okay, so what is the correlation between the US inflation trends and foreign capital flows to equities, especially in technological sectors?
Yeah, when the tech sector has been growing very fast, so you look at the last 20, 25 years, when tech had taken over, the inflation has come down and interest rates have come down. So I would say that technology has generally benefited from lower inflation and lower interest rates. And because the interest rate, even just a few years ago, interest rates were almost zero, inflation was almost zero, and technology was a big beneficiary of that.
Inflation.
Yeah. Until now, technology is still okay, even though the interest rates have gone up. But if you look at the whole long period, technology definitely is the biggest beneficiary from the lower interest rate. Yeah. So if interest rate now is going up, it could be more difficult for the technology, possibly. Not yet, but maybe in the
Possibly.
future. Possible, yeah.
We'll have to see it.
So we'll have to see.
Another coming soon?
Yes, that will be interesting. Yeah.
Okay, so Mr. Sebastian, is inflation still quote-unquote sticky in the services sector, and could that slow down the rally in major indices?
Yeah, it's a very big question. I think that when we had inflation coming down, a lot of that was to do with raw materials like energy, like metals. They were relatively soft, the prices, particularly not so much oil, but let's say things like gas. It became very, very cheap. And obviously, technology is probably the most downstream. So it relies on all of those raw material. Then the price of the raw material is cheaper. It's benefit for the technology. But in recent years, we've seen the prices of the raw materials go up. And of course, that was the reason why inflation jumped before. Then the price came back down again. So inflation came back down again. But I suspect that the material price may be stickier now and increasing. And so the inflation will be a bit more sticky because of the raw material prices.
So the raw materials are like the key.
They are, yeah. And, but in order to produce the raw materials, there is a certain cost.
Yep.
And that goes up over time.
Everything.
And that goes up over time. So I think because the raw material price has been quite low for a long time, there's a possibility that the raw material price will be now increasing instead of previously decreasing. So that will make the inflation a bit more sticky, I think, yeah.
Okay, I see, Mr. Sebastian. And now let's move on, talking about some market index. First of all, I want to ask about the S&P. S&P lately hit several all-time highs this year. Are current valuation still justified if we look at the forward PE ratio?
Well, in Sharp Focus, we don't look at PE. And we do cash flow and not P. P is for profit. We do CF, which is cash flow, which theoretically is the same. But in reality, it's not necessarily the same, but it's real. The profit, not necessarily real. So we focus on the real cash flow. Using the cash flow, yes, it's a bit high, the valuation.
This year?
Right now.
Right now, okay.
And it has been for a while. So it doesn't mean that the market, that is not necessarily going to affect anything in the short term, maybe even the medium term. Could be a year, could be 2 years, it can be high, the valuation. But eventually it will have an effect. So with the way we look at the cash flow now, yes, the valuation is high.
Okay, I see, Mr. Sebastian. So is tech still dominant, or are we starting to see flows into financials and, let's say, industrials maybe?
Yeah, that's because, we're in the news and what people see and what they talk about here. Technology is still, the popular topic.
Still one of the best.
Yeah, and this year we saw Nvidia become the largest company in the world, more than $4 trillion market value. So the technology, the AI is still very much in focus. But if you look at the broader market, this year we start to see other sector starting to do better.
Such as?
Take a very obvious example. It's like the mining, like gold, the gold mining company. Of course, the gold price has gone up.
Yep.
And so the mining company, the profitability has gone up. And they were quite low value before. And so, they're performing. So there are kind of stocks like that you see doing 50, 60% this year, which is much better than the market. So yes, the tech is still the main news focus. But if you look behind what is going up now, I think there's other sector. Even like some consumer also doing quite well now. Maybe because the valuation was low. That's the thing about stock. The real activity sometimes is hidden because people are not focusing on that. And definitely that a little bit of that is happening this year. So yeah, the headline, Nvidia, the tech, but in the background, other sectors
are rising.
Yeah.
Okay, I see. So tech is still dominant, that is true, but still there are other sectors that are doing better this year.
I think more so than before. So before it was all about tech.
Yes.
Other sectors were doing, in some cases, badly. Now, still a bit of tech and still some big headline tech, but some of the others are starting to do better than the tech.
Okay, and that is also interesting.
Yeah, like for example, Apple is minus this year. So that used to be the number one stock, but this year it's not doing so well. And so, yes, but the tech is a bit more split now, not 100% doing well.
Okay, so as you mentioned about Apple, let's talk a little bit about Apple. So Apple's latest earnings showed slowing iPhone growth, but a stronger service revenue. Should investors start valuing Apple as more as software and ecosystem company than a hardware giant?
That is not, at Sharp Focus, we're more focused on what the cash flow is, not necessarily where it comes from. But I would say that, if you look at Apple's sales, actually it's been slowing for quite a long time.
Okay.
It has been flat for quite a long time. The cash flow has been flat for 5-6 years now.
5-6 years, that's
so
quite some time.
Yeah, so sometimes there are things that people don't notice, right? They're so busy. Of course, the share price is going up.
Yes.
They think, must be a lot of growth. But Apple hasn't really been growing for quite a long time now. In fact, the growth now is a little bit better than it was before.
Oh, so it's increasing now.
It's a little bit increasing now, but still not that fast and still a bit flat. But of course, people are not really paying attention with that before. I think Apple has a few difficulties though, because in terms of profitability, see, companies will always go through a cycle, right? You spend a lot of money, you build up your new product like iPhone, iPad. It costs money at the beginning. Then you have huge sales, profitability is very, very strong. But later you have to grow something else, which means you have to spend a bit more money again. And that means that your profitability will be a bit less.
Yeah.
And so the investors quite often are lagging behind, right? And so Apple now is going into probably a bit more difficult time. In fact, all the tech companies, maybe they need to spend a little bit more money. Maybe the profitability is not quite so great. Still good, but maybe not as great. Maybe not growing so fast. And so that combined with the valuation is already high, may be a little bit more difficult for the tech company.
Also, Apple is going to launch a new product, right? iPhone 17, if I am not mistaken. Like in a blink of an eye, they release a new product.
Every year there's a new one, yeah.
And maybe that will also affect their stock prices.
Yeah, I think it's always a lot of excitement when they launch a new product because there are going to be new features. I think this year there's a whole new big feature, which is the iPhone Air, the iPhone 17 Air. So it will be the bigger phone, but lighter weight. But, you know, there's a couple of difficulties, I think. One is there's already an ownership, right, of iPhone.
Yes.
Can you increase the number of owners? Or will it be people just buying a new phone in exchange for the old one? So it's not a new owner, they're just buying a new phone. And I think maybe more like that now, right? So people are upgrading their phone rather than a new owner, than buying for the first time. And so that means the growth maybe will not be as fast as before. And then when you've already built an amazing product like the iPhone is, and then trying to increase the
quality,
value and everything becomes more difficult, right? The price cannot change much, but you keep needing to add a bit more feature. So I think it's going to be tough for Apple, A, to grow the sales part, and B, the profitability and the cash flow may be a little bit under pressure, I think.
Okay.
They need to invest, and then the raw material price is increasing, and they need to keep adding more feature, even though the price is not changing that much. And so, we don't know. I'm speculating now, but I'm not speculating because I see that for many years, Apple cash flow is not changing much. What changed was the valuation of the shares. That went up, but the cash flow, not much. No.
Not moving that much.
No.
And also, Apple's have some kind of AI strategy lately, like AI integration to the latest iOS. And I think that will also affect the valuation and growth projection for like the next 2 or 3 years. Do you agree, Mr. Sebastian?
Not so sure, because difficult to charge for that, right? You can sell the phone, but people expect the software and things, they don't pay for that, right? It's part of having the phone. So if you want to add new features to the software, that's not going to increase your revenue. In fact, it's probably going to increase your costs. So, and AI itself will probably need quite a lot of investment.
Because it's a new feature, an innovation that.
But it's not a service that people necessarily pay for, right?
Yeah.
They already paid for the phone, and the software is given.
Yeah.
So I don't know. I don't know if that will grow the revenue and profit of Apple very much.
I see.
It may increase the cost.
And I think increasing the cost might not be that good.
That's why we go back to what we were talking about before. The technology company had a long period where the cost is going down, the sales is growing very strong. It's a fantastic combination, right? Now, maybe the sales, it can still be growing, but maybe not like before. And then the cost, maybe it's not going down anymore. Maybe it's
probably.
Yeah.
Okay, I see, Mr. Sebastian. So, next up, I want to talk with you about Netflix. It's also interesting because I think Netflix is doing a little bit better. It's going up, and Netflix also boosted the revenue through its password sharing crackdown. Is this sustainable, or is it probably just a short-term bump?
Well, again, from our point of view, we're looking at the cash flow. And so it's true that Netflix has done well. The cash flow was negative before, and then it became positive, and then now the profitability is quite good.
Okay.
Not as good as Apple or Nvidia, but it's quite good. But unfortunately, the valuation is already far ahead of the cash flow. So I don't think it necessarily matters what they do. It's difficult to justify because the market expectation is so high. Yes, they've done well, but it's still far from matching with the market expectation. And so I think for a company like them, it's done well this year, but maybe will be more difficult, I think.
So it's not quite there yet.
Well, it's not matching with the market expectation. That's always the risk, right? The market gets excited, is looking forward, but if the company cannot match that, then at some point the market may get disappointed.
I see. So we'll have to see again what will happen.
And again, it's a bit similar with Apple. How to grow the revenue significantly, how to grow the market significantly when you've already got the big market, it becomes a lot more difficult, right?
Yes,
and then again, you got the same issue that if the inflation is a bit sticky, not necessarily inflation, but just prices they're not going down, they're rising a bit. It becomes a bit more challenging.
I see. So it's
the benefit will swing towards the producer of the raw material. Right? So before the price of the raw material go down, the benefit is to the technology.
Yes.
Maybe now the benefit is swinging a bit towards the producer of the raw material because they still need the raw material.
That is true.
Now the price is going
up for the raw materials.
Yeah.
I see. Okay. So let's say for the US market outlook in general, Mr. Sebastian, if the Fed does start cutting the rates, can the US stock market rally continue on solid fundamentals, or does it risk overheating in sectors like tech or consumer spending?
Well, I would say it's already a bit overheated. And so
really?
I think the risk probably is that if the Fed does cut the rates, the market reaction may not be that positive. If they cut the rates before, then people would have got excited. But I think now it's really, the time has passed.
So it's too late then?
It's a bit too late, and the market already went up. I think as the market expecting at some point they will cut the rates. So when they actually do cut the rates, and actually this tends to happen in history. The Fed is normally the last thing. They're so slow, both raising and cutting. And so the market already went far ahead. So when they actually do whatever they're going to do, it's not necessarily a positive reaction.
Okay, so people might be disappointed, like, why you do it now?
Disappointed, yeah.
Why do it now? Why not earlier?
Yeah.
That might be the kind of reaction that people would give if they actually cut the rates.
Yes, I don't think if they cut rates that it would be that positive for the market, no.
Okay.
Because the market already went up.
So it's far behind them.
It's very far. They're always miles behind. Sorry to say.
But that's
They get paid a lot of money and they're always miles behind.
Okay, Mr. Sebastian. So that is all that I want to ask you today. But as we mentioned in the beginning about the September, things are going down. Do you maybe have some kind of advice to people on how they should act regarding investing in the US market nearing September?
Well, our approach, which kind of learned over the years, is that we always want to be invested. I don't think there's any major problem with the US market. It is the valuation compared with the cash flow is too high, but it can be like that for a while. That's not necessarily a big problem, but for us, better you look for the opposite. So where the valuation is below. So I think, if you look at the US market over time, it always rises. There will be down, there will be up. It can be very volatile sometimes at certain periods. You cannot really know when that will be. You don't know, okay, September is historically dangerous, but we don't know if it will be or not. So I think it's better to be investing, but it's better to choose carefully the company which is not already highly valued. In fact, it's low value, but the company is doing well. So that's what we're looking for.
So looking at the smaller risk.
Yeah, exactly. So generally you can always find something. It may not be the popular area, but there's generally always somewhere where you can find a positive difference between the profitability of the company and what the market expects. And then you can own those shares and you don't have to worry too much, even if the market is negative.
Okay, so now is the right time to be more careful and to look for smaller risk then?
Well, I would say it's always the time, but even when the market is doing very well, it's always the time to be like that. Of course, not everybody is, but for us, that is always the right time.
Okay, so Mr. Sebastian, that is all. Thank you so much again for your time. And for everyone who wants to learn more about investment or want to know more about the cash flow, you guys can visit sharpfocus.com. You can find Mr. Sebastian there too. And we also have a Telegram channel as well. You can join the Telegram channel and see what happens in the US stock market because there are news that have been delivered daily. Am I right, Mr. Sebastian?
Yes.
Okay, so again, thank you so much guys for watching and we'll see you again on our next episode. Goodbye.
Bye.